Today we're talking about the tale of two rates, the tug of war between fixed rate and variable mortgage rates. Now let's set the stage. It's January 2025 and the financial world is abuzz. In one corner, we have the Bank of Canada hinting at further rate cuts that could make variable rate mortgages even more appealing. But in the other corner, a rising tide of bond yields, a key driver in the fixed rate mortgages, threatens to push those rates even higher. This is an epic tug of war shaping the future for Canadian borrowers. Act 1. The rise of bond yields. Picture this. Over the past 2 months, bond yield, those mysterious forces tied to government debt, have surged by 61 basis points or 0.61%. Last week alone, they jumped by 17 basis points, leaving financial experts everywhere reaching for their calculator. Why does this matter? Well, bond yields and fixed rate mortgages are kind of like dance parts. When one moves, the other follows. So this sudden spike has mortgage rate experts sounding the alarm. Get ready for a fixed rate hike, you say. Act 2. A cross-border ripple effect. Now, this story doesn't just stop in Canada, despite being about Canadian rates. Across the border, US bond rates are climbing too, thanks to what some are calling the Trump effect. Following the former president's victory, his pro-growth, inflation-fueled policies are sending shockwaves throughout the markets. From proposed tariffs on Chinese and Canadian goods to tax cuts on tips and overtimes, Trump's policies are like gasoline to inflation fire. And here's the catch. US bond yields heavily influence Canadian yields. So as the US economy moves forward, Canada's bond market follows closely behind. Make sense? Act 3. Canada's inflation battle. Now back home, inflation has become a stubborn guest that just won't go away. In October, the annual inflation rate rose to 2%. That's up from 1.6 in September. And while core inflation, a steadier measure, hasn't skyrocketed, its persistence is a problem. Now, adding fuel to that fire, the Canadian government just announced a $250 payout to 19 million Canadians and a HST holiday for the winter. Great news for shoppers, but for bond traders, it's a head scratcher. This kind of deficit spending could stoke even more inflation, pushing bond yields and fixed rate mortgages even higher, which leads us right into Act 4. The comeback of variable rates. Now, amid the bond yield drama, a quiet trend is brewing, with the Bank of Canada expecting to cut rates further, possibly by another 0.25%. Variable rate mortgages are coming back into fashion. For months, variable rates were the unpopular kid of the mortgage popular, thanks to soaring rates. But now they're starting to shine again. Financial experts like Ben Rabideau are noticing a shift, more borrowers eyeing variable rates for their potential long-term savings. Act 5. Now, what does this mean for you? Here's the bottom line. Fixed and variable mortgages are heading in opposite directions, and the choice you make could have a big impact on your financial future. Fixed rates are on the rise, fueled by climbing bond yields and inflation pressures. If stability and predictability are what you need, locking in a fixed rate mortgage sooner rather than later could be a smart move. Make sure to go lock in those pre-approvals if you're in the market. Variable rates, on the other hand, are poised for a comeback. Now, as the Bank of Canada continues to lower these rates, these mortgages might just become the go-to choice for borrowers who are more comfortable riding the waves of market fluctuations. So what should you do? The answer lies in your priorities. Are you looking for stability in an uncertain market? Or are you ready to take a calculated risk for potential savings? The mortgage landscaping is shifting fast, and timing is everything, and it's impossible to predict, adding just another layer of fun to it. Whether you're a first-time home buyer or looking to refinance, this is your moment to act. Keep an eye on those rates, talk to your mortgage advisor, and position yourself to make the most of the opportunities ahead. Because in the tug-of-war between fixed and variable rates, the real winner is who's prepared. Is it going to be you? Sound off down below whether you're more of a fixed rate or a variable rate, and if you've ever changed your mind on that. We'd love to hear you guys. Thanks so much for watching.